Melly Day with Retail Insight. We are here at the Las Vegas Convention Center for Recon, and joining me, I have two Stan Johnson experts. I have got Maggie Holmes, Director, and Curtis Hodges, Senior Vice President. And we are here this afternoon to talk all things single-tenant net lease, STNL for short. And to cap that off, let's just start with what are some of the trends you're seeing, and is there still an opportunity for investment in today's market?
Yeah, absolutely. Well, it's a good question. The short answer is yes, there's plenty of opportunity. I think in previous high inflationary environments, net lease tends to outperform a lot of other asset classes. During these times, we see buyers, investors exiting, other asset classes, equities, et cetera, and coming to the net lease market. I think as interest rates and inflation continue to climb, or if they do continue to climb, we know interest rates will, but if interest rate continues to climb, I think cap rates will tend to follow. So I think yield, residual value will continue to be favorable to investors.
Okay. And are there any specific opportunities that you're seeing in this environment right now?
Yeah, I think from a geographic standpoint, with the trend since really just accelerating throughout COVID on just population changes throughout the U.S., the Southeast, Southwest are really two regions. We're seeing a lot of activity, tax-friendly states specifically within those regions.
Right? Yes. Any time of the year.
Yep. And then from a tenant use perspective, there's really kind of probably two main approaches in terms of investment in net lease. For the more kind of high quality, new development type projects, we're seeing a lot of interest still in like the Dutch Brothers and the Chipotles, a lot of new developments throughout the U.S. As well as C-store tenants such as 7-Eleven and Wawa and things of that nature. Those are obviously trade at lower cap rates, which becomes tougher in a higher interest rate environment, but we're still seeing a lot of interest and demand in those types of products. And then for investors who are looking for maybe a little bit more yield, we're seeing a lot of interest in kind of that medtail, the new phrase medtail sector. And so whether it's a dental clinic or dialysis or urgent cares, a lot of these tenants and operators are a little lesser credit, which is why you obviously see the higher yield. But that sector specifically is likely going to see a lot of consolidation and roll up over the next coming years. And so that provides the opportunity for the potential of credit enhancement for many of those operators over time. So more yield, but obviously room to grow.
So it sounds like convenience is a huge factor, drive-throughs, and kind of on the same plane, convenience with the medtail, being able to get to medical providers with retail.
Quicker, yep. I think that's the key. I think convenience, the new world, especially what's been really accelerated, like I said, through COVID, just the need to have things closer and more accessible.
So what are some of the bigger questions you're fielding from investors nowadays, either within the multi-tenant or single-tenant net lease market?
So single-tenant, I think a lot of people just with inflation, kind of at the forefront of every investor's minds, rental increases are a big question, and it's either, they're looking at long-term leases with more robust escalators, or they want shorter-term deals, so they want to do market-to-market rents, be able to capture those market-to-market rents. At least that's what I'm seeing.
What would you say is the best advice that you would give for people out there in the market?
I think just like with, any times of uncertainty in the economic environment, I think that there is huge opportunity, and I think there's no exception with net lease. If there are new investors wanting to enter the market, my advice to them is to be diligent, determine what your risk tolerance is. If you can't take on a ton of risk, you want to focus more on the credit, more, well-located deals. And then if you can take on, a little bit more risk, maybe you're looking at sub-investment grade credit, shorter-term deals, or maybe, considering less primary, more secondary, tertiary markets.
Right. And emerging tenants, right? That can be another way to kind of get in
Yeah,
into the
get in
market.
early, and I think
Yeah.
that's been the development of the net lease market going back 20, 30 years. I mean, a lot of these tenants, the cap rates, you can look at cap rates over time, and you know, a lot of the investors who are selling off today are, you know, bought a great opportunity 10, 15 years ago, kind of that emerging tenant concept. And so whether it's medtail or daycare facilities, which obviously have lesser credit and have some nuances with their leases, but those, you know, are also going to experience some consolidation and credit enhancement over time.
Yeah, so a little bit of a risk, but potential for great reward.
Yeah.
Obviously, still opportunities in the sector, but like with everything with retail, always changing, always adapting.
Yep.
Can never quite keep your finger on the pulse, right?
Yep.
Absolutely, yeah.
Well, thank you so much, Maggie and Curtis.
Absolutely.
Yes.
Thanks.
Thank you.
This is Nellie Day with Retail Insight.